In this video, I'm going to show you a method of using MACD or MACD to identify buying points in the S&P 500, which has a win rate of over 90%. I'm going to show you a detailed backtest report using over 15 years worth of data, so you can see this method has been working for quite some time. Firstly, let's go through the details of the strategy. Let's look at the entries and the exits on the whiteboard, and then we'll go over to the computer where I'll show you the results using the performance report. The S&P 500 market is very mean reverting, especially on a daily time frame. This means that buying short-term drops and then selling back into strength works very well. There are quite a few methods to trade the S&P just like this, and they're essentially all the same: buying into weakness and selling back into strength. One of my favourite ways to do this is by using RSI to identify weakness. And I'll link a video that I've created all about this so you can see exactly how to do that. I'll link that up above and in the description down below. With this MACD strategy, the first thing we want to look at is whether we're in a longer term uptrend or not. And this is done by looking at the closing price and the 200 period moving average. This is all on the daily chart. We need to see that the closing price is above that 200 period moving average. That's condition number one. The second thing we need to look at is whether the closing price is under the 10 period moving average. So basically what we're saying is, short term the market hasn't rallied too much and there is room for buying opportunities. So we need to see the price above the 200 period, longer moving average, but we need to see it below the 10 period moving average so that we've got a little bit of short-term weakness. And the third thing we're going to look at is the MACD or MACD indicator. And especially we're looking at the MACD histogram. We're not too bothered about the lines. We're just looking at the histogram, which looks something like this. Now, hopefully you can see these red lines are the histogram, and they pretty much typically look something like this. We've got a line that goes through here, a horizontal line, which is a zero line. Anything above is positive, anything below is negative. We're only looking at negative values mainly. Now, what we need to see is we need to see the MACD histogram tick up. So we need to see a bar that is greater than the previous bar, just like this one here. Now, this bar here has to be negative. So we could see that this bar here has just ticked up from this bar, but that's not a trade because we're in positive territory there. We have to be negative. We also need to see that this bar has ticked up from this bar, but this bar has to be lower than the previous bar. So otherwise what we'd be doing is taking too many trades. For example, if we've seen this is our trigger because the bar has ticked up and we're in negative territory. Let's say we exited this bar here, but on this bar we're also ticked up from that bar, so that would be another entry. But no, it wouldn't be another entry because of this rule. So because this bar was not above this bar, that's not a condition. So we need to see, essentially we'll end up with like a kangaroo tail, as I call it, with some price charts. We end up with this extension of the middle. The previous bar is higher, and then this bar is also higher, so it ticks up. And then once we've seen that happen, we've got condition 1 and condition 2, then we literally buy on the open of the market the next day. The exit is much more simple. The exit is a simple first profitable close exit. So at the end of each day, we look to see if we're in profit or not. If we're in profit, then we'll exit on the next open. If we're not in profit, then we leave the trade running. And we'll discuss a stop loss for this strategy when we go over to the computer. I'm using the SPX CFD from Oanda, which tracks the E-mini very well. The results that you're going to see are in points. So for whatever market you're using, you need to multiply the dollar value by the amount of points that you see in my backtest report. I often create free reports for this type of strategy, listing all the rules, including the performance report. If you'd find that useful for this strategy, if you're interested, let me know in the comments and I'll create that report and I'll probably leave it in the description somewhere or possibly in the top pinned comment so that you can download that for free. Now let's go over to the computer and look at the results. Here in this first workspace, we're looking at the full dataset range. So we're looking at data from the 1st of January 2005 through to the end of April 2021. Now on this upper chart here, we can see this cyan line here is the 200 period moving average, or the 200-day moving average. And this cyan line, which hugs the price a bit closer, is the 10 period, or the 10-day moving average. Down below, we've got our MACD, or MACD indicator. And in the red, we've got our histogram, which is what we want to be taking most notice of. This trade here is an example buy trade. The setup was actually on the day before, and the buy is initiated on the opening of this bar. So this bar was where the setup occurred. We can see that the close, where the little finger is below the 10 period moving average. The close is above this 200 period moving average. And if we look down here at the MACD, we've got, it happened on this bar here, where the MACD ticked upwards from the prior bar, and we're in negative territory. And prior to that one, the bar was above it as well. So there were 3 conditions all met, and then we bought on the open of the next bar. We had a couple of closes where the price was negative or we were showing a loss, and then finally on the 4th bar we closed in profit, so then we exit at the open of the next bar. Let's scroll back and have a look at some more trades. So we can see some more. Here would have been the setup bar, close below the 10 period moving average, close above this 200 period moving average, and the MACD histogram has ticked up. So then we go long on this bar here. On the same bar, it closed that day in profit, so we exited at the open of the next bar. So it's that simple. Looking at the equity curve then, this equity curve shows us the new highs where the green dots are, and this is showing the close to close equity curve. So after each trade is actually closed out, and you can see it's a really nice looking equity curve. But remember, it is a close to close equity curve. If we look at the equity curve which shows daily profits, we can see that we've got these big drawdown periods, and partly because we're not using a stop loss. But if we ignore the drawdown intraday and just look at the close to close after each trade, then we've got a really nice looking equity curve. Look at the total trade analysis, we've got 58 trades and a percent profitable of over 96%. Really accurate. The average trade value is an average trade of 14 points. The largest losing trade was only 1.4 points, and the largest winning trade was actually 81 points, so that's massive. But to get that 81 points, or to get that average trade of 14 points, we have had to sit through some big drawdowns. Nonetheless, we know it's a very accurate strategy using that MACD indicator. And part of the reason why this kind of strategy has such a high win rate is because we're only looking to buy, and because it's a stock index, we're looking at the S&P 500, which traditionally just goes up over years. That's an edge in itself. If we flipped around the rules and looked at short trades, we wouldn't get anywhere near the sort of results that we're looking at on the buying side. So with stock indexes, looking for buys only, that is why we get such a big edge. But now we need to think about a stop loss, and we're going to try one out. But before we do, if you find this video interesting and you like it, then please give it a thumbs up now and subscribe to the channel for more videos just like this one. In this next workspace, I've applied a stop loss, and I've just used a fixed 200-point stop loss. I know from experience that with this sort of strategy, 200-point stop loss does work quite well. And if we scroll back, we can see some trades. Here, for example, we've been stopped out of that trade. Obviously, with such a high win rate, we're rarely going to be stopped out. We can see all these trades are all in the green. Let's have a look at the performance report now. Now, the equity curve close to close does look quite different. You see these big drops. This is essentially where we've been stopped out. This big drop, mind you, is just one trade, and this big drop here is just one trade. Because with this type of strategy, it's so accurate. We just take little bits of profit, and most of the time we're right. But when we are wrong, we take a very big loss in comparison to the small regular profits that we've been taking. Looking at the normal equity curve, we can see these drawdown periods, again, not quite as severe as they were before. If we look at the net profit of this strategy with the stop loss, we're looking at 531 points with maximum drawdown of just over 400 points. Whereas looking at the strategy with no stop loss, we've made more, not double more, but look how big our strategy drawdown is now. The drawdown's 871 compared to 401, so it's well over double of what the drawdown was using a stop loss, and the profits are not double, so it does benefit to use some sort of a stop loss. Looking back at this workspace with the stop loss, we have got slightly more trades because we're being stopped out of some a bit earlier. We've still got a very high win rate of 91%. Average trade has come right down to only 7 points. But even with some trading costs, obviously we are still making money using this strategy. I haven't done too much work to investigate tackling these issues of large drawdowns with these type of mean reversion trades, but perhaps I should. People like Larry Connors have put a hell of a lot of effort and work into researching these types of strategies, and I haven't actually read anything that he's published which comes up with a good type of stop loss to tackle the drawdowns. That's not to say that he hasn't found something, and it's something that I should probably be working on. If you have any ideas of how to tackle this issue with the large drawdowns with these mean reversion strategies, especially on the S&P 500, let me know in the comments and I'll test it out. That could be the focus of a new video and study for us. These days, the majority of my time is spent looking at strategies and trading the Forex markets, which move quite differently to the likes of the stock index like the S&P 500. To conclude then, if you like strategies like this, which have a very high win rate, they take a lot of small profits often, then you might be able to get some use out of this one. As I said earlier, there's lots of different methods, like the RSI one that I linked, that all do a very good job of identifying these pullbacks in the S&P 500. So pick one that you like. Don't trade them all together, because essentially they do the same job, and essentially you'll just be taking one large position. Just choose the one that you think works best for you, is the easiest to identify the signals for you. That's about all for this video. So I hope you found it helpful, and until the next one, this is Jared Goodwin, and thank you.